Hello, everyone. This is Ted Bauman here, editor of the Bauman Daily and of the Bauman Letter. Thanks for everyone who had comments on last week's video about the differences between Austrian and Keynesian economics. I know a lot of you disagree with my interpretation of both, but I do think it's important to bear those kinds of differences in mind. A lot of people wrote in to say that they believed that certain arrangements work better than others without really referring to any specific history. And that's the critical thing. You've actually got to have evidence to back up your assertions. Just believing something because it suits your worldview is not always the best way to approach things. Anyway, let's talk about the big boogeyman out there in the markets right now, and that's inflation. We've been talking about inflation a lot this year. I want to take a deep dive into what happened this month to look at some of the background, some of the, disaggregate the inflation. But first, let's look at a couple of charts that show exactly what happened. Well, first of all, we can see that there was a big dive in stocks yesterday. I'm recording this on Thursday. Basically all week, it's been bad for stocks. There's really been a big just pullback right across the board. And inflation ultimately is the big fear here. I think, we've looked at a lot of other things. I believe that the failure of the Democratic Party to make any real progress on an infrastructure bill is probably also a big drag on the market. It looks like they're probably not going to be able to do that, at least in the form that they've proposed, because of differences within the Democratic caucus. Anyway, inflation really is the thing that's dragging things back. And this week, because of the April report, it was really bad. Now, here's why investors worry about inflation. Here's a chart that shows the comparative returns of different types of asset classes depending on the state of inflation. Now, normally under inflationary episodes, commodities do well, gold does well, cheap stocks do better. But when there is inflation, essentially the S&P 500 and Treasury bonds tend to do very poorly. And of course, those are the primary holdings of most investors. So although there's a place to be had in commodities and companies that produce commodities, people are right to be worried about inflation, at least as far as the stock market's concerned. Now, let's look at opinions about inflation. This is a chart that shows the number of people who believe that that the break-even inflation rate is going to be higher in the future than it is now. It's risen substantially since dropping to a low back in March last year, but it's now higher than it was before the coronavirus struck. So fundamentally, the market is beginning to price in expectations of inflation. And some people are saying, well, this is the single most important question this year, whether the shift to inflation is purely temporary, as the Fed believes it is, or whether it would be a permanent shift towards a higher inflation regime, in which case investors would be right to worry about it and therefore punishing stocks. But the thing is to remember that Wall Street doesn't really have a very good reputation when it comes to understanding inflation, even very recently. That's because they don't really know how inflation works. So let's talk about that. Let's talk about what just happened. So excluding food and energy, U.S. inflation on a month-on-month basis was 3%. Now, that is higher than it has been in the past, but not that much higher. Here's a chart I put together that shows the CPI percentage change from previous month going back to 1960. The red dotted line is a 5-year moving average. The blue line is basically that month-on-month change. Now, you can see roughly where we are in April. We have exceeded that quite a few times, including as recently as 2011, 2012. And what's interesting to me is that inflation tends to spike in the aftermath of a big pullback in the market, a big depression. Now, the difference is, of course, those two big spikes back in the 70s, and I'll talk about those in a moment. But critically, inflation tends to spike in just after a big pullback in the economy. We saw it in 1989-90. We saw it after the dot-com boom bust. We saw it after the 2009 financial crisis, and we're seeing it now. So historically, this is pretty normal. But as you can see, the long-term trend for inflation is down, and that's an important consideration. It's not just about money. It's about other things as well, which I'll talk about in a moment. So now let's disaggregate the April figure. Here's a couple of different industries that illustrate that this is not a widespread phenomenon. It's about supply constraints. Here's a chart that shows used cars and trucks versus CPI altogether. Now remember, used cars and trucks appear in CPI, so when they rise 20% month on month, or as they have done over the past 2 months, about 10% each time, then yes, of course, you're going to get an uptick in overall CPI. But not everybody is buying a car and truck right now. Here's another chart that shows the percentage change in rental car prices. I mean, that's a huge, huge jump. And it's due to the fact that a lot of those companies sold off their rental car fleets last year in an effort to raise cash to avoid bankruptcy. And now they don't have enough cars to get, to serve their customers. And as a result, prices have gone through the roof. Now, here's a third chart that shows just the distribution of inflation. Now, we've looked at two parts of the transportation part, which is cars, trucks, and rentals. But look at some of the other, looks at inflation, some of the other markets. In January 2020, basically inflation was fairly moderate right across the board for most sectors. And in April this year, most of them matched it. I mean, the inflation in medical care, shelter, personal services, education, furnishings, communication, recreation is not all that different from what it was last year. But look at the two big ones. Apparel and transportation had a huge decline in price this time last year. And this time this year, in one case, in the case of apparel, it was still falling, but this year it's rising. Now, why is that significant? It means that in the sectors where prices fell the most during the COVID pandemic, they've risen the most this time because supply was constrained. In other words, they cut back on their ability to produce, they cut back on their ability to supply customers, and now they're having to play catch up, and in the meantime, prices are going up. Is that a recipe for long-term inflation? No, it doesn't have to be. Depends on how you respond to it. Here's another chart that shows another way of looking at inflation. This includes lodging like hotels and motels, that's the red line, airline fares, and cars and trucks, which we've already looked at. Again, we saw a huge drop back in April, May last year, and now we're seeing the results of the curtailment of supply as a result of that drop. So again, this is perfectly well to be expected. Next chart shows an index that takes out things like car and truck rental, transportation, recreation, lodging, etc., and then says, all right, well, what was the contribution of these things to, it adds those things in. What was the contribution of those things to inflation in this particular reading? Well, as you can see, the contribution back in this same time last year was very negative. Those prices fell, and in response, people curtailed their ability to provide those things. They fired hotel employees, and they closed down, hotels, motels, all kinds of things were curtailed. Now, what we're seeing is as the economy reopens, those are exactly the things that are pushing inflation up. So in this sense, this is absolutely a result of the short-term effect of inflation as a result of what people did during the COVID crisis last year. Now, the question is then, what is the long-term trend of inflation? And is there some kind of a reason for us to expect that inflation is, in fact, headed for a continuous rise? Well, here's a chart that shows different kinds of inflation: goods, services, and then core personal consumption expenditures, which are basically things like food and lodging and so on. And then there's the Fed's 2% target. Now, as you can see, core CPE, which is the stuff that people, basically disposable goods that people use on a daily basis, has remained under 2% for a long time. Services have peaked up above it periodically, but the big loser has been goods. In other words, the consumption of physical goods has been not resulted in inflation. In fact, it has helped to keep CPI down for a long time. One reason for that is because of the big gusher of cheap goods coming from China. But another reason for that is that over the last decade, the very slow recovery from the great financial crisis meant that a lot of people couldn't actually afford to buy stuff. That's why we saw really slow recovery in a lot of major consumer industries. Now, we see that goods spike is starting to rise up above the 2% again. But look back to last time it did that. It did that in the aftermath of the great financial crisis. And as I said earlier, that's entirely to be expected because you have to play catch up. When the economy tanks like it did in 2009 and also in 2020, people cut back on production. And then when people go back into the market trying to buy things, their prices are higher. Same thing happened in 2010, 2011 with automobiles. You remember the Cash for Clunkers program when the Obama administration bought cars out of the market? Well, that drove up the prices of used cars, just like what's happening today. So in a sense, there is plenty of historical precedent for what we're seeing right now. Now, again, let's just review what the key drivers of inflation have been in the April data. Car and truck rental, motor fuel, energy, in other words, energy commodities, used car and trucks, airline fares, hotels, and motels. So fundamentally, folks, what we're looking at is a situation where inflation has been concentrated in very specific areas of the consumer economy. Now let's look at what's happening in the producer economy, because the other thing we've heard is that there have been big increases in the prices of inputs to manufacturers, also housing construction, lumber, and so on. We've seen it with microchips, we're seeing it with commodities and so on. Well, the problem is that, the Econ 101 understanding that prices rise when there's a misalignment of supply and demand is not really very helpful in the short term. In the real world, corporations don't raise their prices just because their input prices are going up on the short-term basis. That threatens their position in the market, that threatens their market share, it threatens their relationship with customers. For example, petrol stations around here in Atlanta that have raised their prices as a result of the cyber attack on the fuel pipeline are getting punished by customers, shaming them on Facebook and Twitter, saying we're not going to shop there anymore. All companies feel that way. They don't want to be seen to be gouging people. So here's a chart that shows the relationship between manufacturing inflation, in other words, producer prices, the prices of things, like raw materials, imported goods that go into the manufacture of things, and so on, versus consumer prices. Consistently, when there's a big spike in producer prices, you do not see a corresponding spike in consumer prices. That's because it's usually temporary and because manufacturers know that. As a result, they don't want to get into a position where they make pricing decisions that are going to be negated within the next 6 to 12 or 18 months and alienate customers, alienate retailers, and so on. Now, the question now is, will this inflation stick around? Now, some economists argue that a change in the price level can lead people to expect higher prices in the future and therefore to start pushing prices higher on their own. That's called adaptive expectations. So that, theoretically, if you take a very strict, almost Austrian view of the way that people operate theoretically, if you expect inflation to be higher in the future, you will demand higher wages or higher prices for whatever it is you sell or produce now, which will then become a self-fulfilling prophecy. So that upward spiral, that's what happened, it is claimed in the 1970s, that was all about forward expectations. The other thing, of course, is that if that happens, if you do get a upward expectations starting to affect the economy, that in itself becomes a supply shock, because as prices rise, some people may decide to raise the prices of their own goods, which then makes them more difficult for people to afford, which increases their relative scarcity relative to need. So there are lots of reasons why we shouldn't expect what happened in the 1970s to happen now. Here's three of them. There are three things that have historically underpinned high and rising inflation. And really the 1970s is the only good example that we have in the United States economy. One is currency volatility. One is commodity crises, like the 1970s oil embargoes. And the third is the role of unionization and their ability to act on that adaptive expectations of prices rising and therefore demand higher wages. So let's start with unions. Here's a chart that shows the membership of unions over the years. It was already declining in the 1970s, but starting in the 1970s, the percentage of workers who were in a union began to fall precipitously. That yellow line is basically private sector unionization, which has fallen from nearly 30% at the beginning of, well, let's say 27, 28% at the beginning of the 1970s, down to under 8% now. The red line shows all wage and salary workers, which would include government and nonprofit agencies. So one of the key lessons here is that the ability of the average worker to demand a wage that is higher because they expect prices to be higher in the future is dramatically curtailed relative to the 1970s. We're not in the 1970s anymore, folks, when it comes to labor supply. And of course, this chart shows one of the things that has happened as a result of that is that as the union the union membership rate has fallen, so has the middle class share of national income. And that's precisely because people are no longer able to demand their share of income from their employers. And as a result, more and more money has gone to the top. Now, that means that a lot of people who would have had money to spend on goods and services in the 1970s and therefore push up prices no longer have that much money relative to the rest of the economy. That means their ability to drive up inflation over the long term is much lower than it was. Sure, stimulus may raise their short-term ability to purchase, but eventually that stimulus is spent and then this trend recovers. So that's a reason not to expect long-term inflation because of the structure of the labor market, which has changed. It now favors the bosses, not the workers. Now let's look at the US dollar index. All things being equal, a weaker US dollar results in higher inflation. And that's because it means that we have to pay more in dollar terms for our goods and services. So here's a chart that shows the ups and downs of the US dollar relative to a basket of trading commodities up until 2015. The dollar really fell in value until the Bretton Woods Agreement, which was a fixed rate agreement between the dollar and others, fell apart in the early 70s, and Richard Nixon took us off the gold standard. But then it rose again during the Latin American debt crisis as people fled to the dollar. Then it fell again, and it remained pretty much in a tight band between about 80 and 100 on the index for most of the decade, until we had the Asian financial crisis right around the turn of the century. And there was the dot-com bust. Then we had the housing bubble, and then the financial crisis and quantitative easing. The interesting thing is that the only really active Fed policies to pump money into the economy occurred during that financial crisis. And as you can see, the dollar did not weaken or didn't weaken all that much relative to the amount of money being pumped out. More recently, the dollar has strengthened, which is actually anti-inflationary. Sorry. So let's look at another chart that shows that relationship, but the two overlaid. The yellow line is the dollar index. The purple or pink line is the inflation change, a year-on-year change in inflation, quarter-on-quarter change in inflation. One more time, month by month. Now you can see but previously there was a pretty strong reaction to any move in a strengthening or weakening or a strengthening of the dollar. You see the dollar weakening during the early 70s, and then as a result, inflation going way up. Then the dollar strengthened, and boy, inflation came right down. Dollar weakened again, went up. And then inflation began to pick up or rather, once it was contained, you saw the dollar strengthen to a very, very high peak during the late 90s. But then the dollar kind of fell down and traded within a fairly narrow band. And ever since then, inflation has really been low. I mean, the amount of change month on month in inflation has been extremely moderate relative to the past. And that's even the case in periods when the dollar has strengthened, as like, for example, in the aftermath of the dot-com bust. More recently, we've seen a strengthening in the dollar. Paradoxically, we shouldn't be seeing a strengthening in the dollar if the Fed is putting out so much money into the supply, but we are. And part of it is because the Fed's activities are driving up the prices of U.S. equities, and people are buying those equities. And in order to do that, they have to buy dollars, and that drives up the price of dollars. So fundamentally, we don't see any relationship between unionization and the rate of inflation. We see that unionization has declined to a point where it can hardly be considered a real driver of long-term structural inflation. And remember, that means that workers cannot act on any adaptive expectations they have about future inflation to demand higher wages because they just don't have the power to do it. The second thing, of course, as I've just said, is that we don't really see any reason, at this point for the dollar to fall. And even if it did, it wouldn't necessarily produce much inflation because it hasn't done that for most of the last 20 years. So A lot of people tend to look at this situation and say, well, the central banks have done a great job. They've been able to keep inflation under control. The problem is, I don't necessarily think that that's the case. I think the Fed actually wants to see more inflation, but they're struggling to achieve it, and they're struggling to achieve it because what Milton Friedman said years ago, which is that inflation is always and everywhere a monetary phenomenon caused by more money in the economy, is just not an empirically verifiable fact. It has not been the case for nearly 30 years. There's also very little research that shows that budget deficits lead to lasting inflation. What that tells me is two things. One is that most of our inflation back in the 70s was driven by structural factors, like the strength of unions, their ability to demand higher wages in annual wage agreements, the volatility of the dollar, and then finally those big supply shocks, which really were all about the oil supply to the United States. All of those things came together to create an historically unusual and unique situation, which we're not facing right now. So when people say we need to raise interest rates to combat the current round of inflation, what should we say in response? Well, first of all, I would say absolutely not. To take what is in effect a used car economy, as somebody put it, where we have a short-term shortage of things and try to raise interest rates in order to slow things down and inflict unnecessary pain makes no economic sense based on what I've just showed you. But here's what I think. Number one, I think that recent stock market valuations, and by recent I mean almost the last decade, have been driven by speculation that is rooted primarily in Federal Reserve policy, don't fight the Fed. And it's been like that so long that many investors, even on Wall Street, have forgotten that ultimately corporate valuations depend on the real economy. That means growing revenues, investment, and consumer spending. Now that we're starting to see that, and we're starting to see a little bit of inflation as a result, they panic. And they're right to panic because it means that their speculative approach to trading, which is based just on things like interest rates as opposed to real production, is beginning to fall apart. That paradigm is beginning to crash. It's a good thing that it crashes. We need to get back into investing based on the real economy. So, second thing, the solution to short-term inflation is not to clamp down on interest rates. That's in no one's interest other than those speculators in financial assets. They want interest rates to go up because it will help preserve their ability to make big profits out of trading financial assets that do nothing for the real economy. For example, there's an alternative. The Biden administration wants to spend billions of dollars to try to increase the production capacity of microchips. Well, that'd be great because the best way to fight inflation in microchips is to make more of them. And to do that, you need high prices to prompt companies to respond to those prices by increasing output. That's Econ 101. Now, in the short term, investors know all of this perfectly well. That's why they are drumming up fears of inflation. They want to take your shares away from you at low prices so that they can make money on those shares in the future and not you. So my advice to you is don't fall for this inflation fear. It is not rooted in a structural change in the economy. If that structural change comes, as I mentioned a couple of weeks ago in one of my videos, then we can worry. Remember I talked about those four things, one of them being labor unions, one of them being foreign inflows and other things, deficit spending, all these things. If one of those things disappears, yes, we'll have a problem. But right now, that's not the problem. We have the opposite problem. We need to invest in production so that we don't have supply shortages in the future, and so the economy can grow and work well for everyone. Anyway, this is Ted Bauman signing off. I'll talk to you again next week. Bye-bye.